Everyone has an opinion about Realty Income. Some say it's the safest REIT on the planet, others say it's dead money. So here's the real question: who's right? Today we'll look at the data and settle this debate once and for all. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term, triple net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. The company is currently available with a 5.72% starting dividend yield compared to its 5-year average of 5.04%. The price-to-AFFO ratio is now 13, while the 5-year average was 14.9, and the sector average is around 14.8. The stock is trading at about $56, whereas the expected price is estimated to be between $58 and $71. Based on these metrics, the company appears to be slightly undervalued. The company currently pays $3.24 in dividends per year, distributed monthly in 12 installments. The next dividend payment will be on December 15th, and anyone who holds shares by November 28th at the latest will be eligible to receive it. The most recent dividend increase was 2.9%. The average increase over the past 5 years is also 2.9%, while the 10-year average was 3.6%. The FFO payout ratio is well below the healthy 90% threshold and has been showing a strong downward trend. FFO per share, on the other hand, is on a steady upward trajectory. The growth isn't very fast, but it is stable, and the company even managed to grow during COVID and continued to perform well in today's high interest rate environment. The company issues new shares every year, which is completely normal for REITs. These issuances typically fund expansions, renovations, and dividend payments. As long as the total sales chart grows at least as fast as the shares outstanding chart, this does not pose a problem, and that condition is being met here. The company did take on a bit more debt than ideal during COVID, but management took this seriously and began reducing leverage. Based on expectations, the company could once again fall below the 5.5 leverage target within the next 12 months. Meanwhile, the interest coverage chart has remained comfortably above the 2-point threshold for the past 10 years. In short, the company is currently available with a nearly 6% starting dividend yield, with the most recent dividend increase around 3%. It holds an A- credit rating, and the dividend appears to be safe. Based on the overall fundamentals, the company may be slightly undervalued and could be an attractive entry point for more conservative dividend investors. The fact that it pays dividends monthly is an additional bonus. When you look at Realty Income's latest quarter, the first thing that stands out is how consistent the company continues to be. Even in a higher rate environment, they deployed $1.4 billion in new investments, including $1 billion in Europe at an 8% yield, while U.S. investments came in at a 7% yield. Sourced volume has already reached $97 billion year to date, surpassing last year's record. Operationally, the quarter was extremely strong. Occupancy reached 98.7%, and the 103.5% rent recapture rate across 284 released properties shows that not only are tenants staying, but renewed leases are being signed at even stronger economics. Financial flexibility remains solid as well. Realty Income ended Q3 with 5.4 times net debt to EBITDA and a 4.6 times fixed charge coverage ratio. After the quarter ended, they added approximately $1 billion in unsettled forward equity and issued $800 million in unsecured notes at a 4.4% yield, further strengthening their liquidity position. Management reaffirmed their AFFO per share guidance of $4.25 to $4.27 and raised their investment volume outlook to $5.5 billion for 2025. This increase signals confidence in sourcing attractive opportunities despite a challenging environment. Looking beyond the quarter, Realty Income's long-term portfolio stability continues to differentiate the company. Their occupancy levels have held around 98% plus for decades, including during recessions and shocks, far above the median REIT. Credit losses remain exceptionally low, averaging just 0.4% between 2014 and 2024. This reflects high-quality tenants, disciplined underwriting, and strong asset management across a massive global portfolio. Europe continues to be a major growth driver. Since 2019, Realty Income has invested nearly $15 billion across 8 countries, with an average remaining lease term of approximately 8.3 years and strong rental economics. Management believes Europe offers a larger total addressable market than the US, supported by lower competition and more favorable debt costs. Across the entire portfolio, Realty Income's global diversification by tenant, geography, property type, and industry remains one of its greatest strengths. These slides demonstrate how size, scale, and geographic breadth contribute to unparalleled cash flow durability. Realty Income's predictability remains unmatched. High occupancy, strong recapture, minimal bad debt, and continued global expansion, including Europe. The balance sheet is also robust, supported by strong credit metrics. The main challenge is the higher cost of capital, which tightens acquisition spreads. Only 4% of sourced volume has been acquired in 2025 year to date, highlighting tougher deal economics. General and administrative costs are slightly elevated, and 5.4 times leverage, while safe, is on the higher side of Realty Income's historical range. This quarter reinforced everything Realty Income is known for: stability, disciplined growth, and strong global diversification. With high occupancy, reliable cash flows, and steady AFFO performance, the company remains one of the most dependable income-producing REITs. Despite headwinds from interest rates, Realty Income's long-term fundamentals, scale, conservative underwriting, and mission-critical real estate remain firmly intact. What if I told you there's a 187-year-old company that survived world wars, recessions, inflation spikes, pandemics, market crashes, and still manages to grow your money quietly in the background? Today, we're diving into Procter Gamble, a company so stable it's basically the financial equivalent of brushing your teeth. You do it every day. You don't think about it, but it literally compounds your life. Let me show you why investors treat P&G not just as a stock, but almost as a wealth-building machine. With roots tracing back to 1837, Procter & Gamble is among the oldest dividend aristocrats. The company is one of the world's largest manufacturers of laundry detergents, baby wipes, diapers, paper towels, cleaning products, shampoos, deodorants, toothpaste, and other consumer goods. Some of the firm's top brands include Luvs, Pampers, Tampax, Charmin, Tide, Cascade, Dawn, Febreze, Head & Shoulders, Old Spice, Pantene, Gillette, Braun, Crest, and Oral-B. Around half of P&G's sales occur outside of North America. The company is currently available with an initial dividend yield above 3%, while the 5-year average was only 2.47%. The price-to-earnings ratio is now 19.6, compared to the 5-year average of 23.8, while the sector average is around 16.2. The stock is currently available at about $138, whereas the expected price is estimated to be between $152 and $186. Based on these metrics, the company appears to be slightly undervalued. The company currently pays $4.23 in dividends per year, distributed quarterly. The next payment will be on February 18th, and anyone who holds shares by January 26th at the latest will be eligible to receive it. The most recent dividend increase was 5%. Over the past 5 years, the company has raised its dividend by an average of 6.1%, and over the past 10 years by an average of 4.6%. For years, the earnings payout ratio has consistently remained below the desired 70% level, and over the next 12 months, it is expected to be around 60%. The free cash flow payout ratio has also stayed below the acceptable threshold for many years, though it is somewhat closer to the upper limit of what is considered healthy in the long run. There is still no cause for concern at this point. Both earnings per share and free cash flow per share have been steadily increasing year after year, with only a few exceptional years. This is exactly what the earnings and sales growth charts show. Slow but stable growth characterizes the company. A key part of the company's strategy is share buybacks, something shareholders typically appreciate, especially when total sales continue to grow steadily, as is the case here. This means shareholders get an increasingly larger share of the company's earnings each year, even if they don't add to their positions. Return on equity and return on invested capital have both been well above the desired levels in recent years. The same is true for operating margin and free cash flow margin. The company's debt level is considered low. Management handles it responsibly, making sure leverage remains under control. The interest coverage chart has also been at very healthy levels over the last 10 years. In short, the company is currently available at a historically high dividend yield of over 3%. Its most recent dividend increase was 5%, and it holds an AA- credit rating, which is considered excellent. The dividend appears to be very safe, and based on the current valuation metrics, the company may be slightly undervalued. It is again best suited for more conservative investors who are not seeking explosive returns, but prefer peace of mind and steady, gradual growth.
Disclaimer. This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video.
All right, let's kick things off with the CEO's message. What really stood out to me is the confidence. P&G openly admits the world hasn't been easy lately. Inflation, supply chain mess, consumers suddenly acting totally differently than a few years ago. But they don't sound worried at all. In fact, they frame the whole year as proof that when the world gets shaky, strong brands always come out on top. And in their mind, nobody does strong brands better than them. And here's a fun little detail that explains why they can be this confident. P&G spends over $8 billion every single year on advertising. That's more than Coca-Cola, McDonald's, and Tesla combined. When you wonder why people keep reaching for Tide or Gillette without thinking, yeah, this is why. Brand loyalty for them is not an accident. It's an investment. Now, when you look at how P&G actually operates, they're not trying to reinvent the wheel or chase flashy trends. Their entire strategy basically boils down to a surprisingly simple idea. Make the best possible version of everyday products and improve them every year. Not just good, not almost as good as the competitor. They want superiority. And they measure that across everything: the product itself, the packaging, how it feels, how it smells, how it's presented in the store, even the whole experience of using it. It's basically P&G saying, if ours is better, you'll buy ours. And if we keep making it even better, you'll keep buying ours. And to make sure that actually happens, they use something they call constructive disruption. It sounds like corporate jargon, but the idea is pretty cool. They encourage employees to question old habits, tweak systems, and constantly look for improvements without causing chaos. Think of it as innovation, but with a seatbelt on. 2025 was another classic P&G year. Steady, predictable, and very, very profitable. Share prices were stable, cash flow was huge, and if you're a dividend investor, here's the part where your ears perk up. P&G extended its 68-year streak of raising its dividend. Let me put that into perspective. P&G has paid and increased its dividend through wars, recessions, pandemics. It even outlived the Great Depression. This is why a lot of long-term investors treat P&G like a kind of private savings account that sends you cash every quarter. Now, instead of throwing a bunch of numbers at you, let me paint a simple picture. Imagine a machine that takes money people spend on toothpaste, laundry detergent, and razors, and turns it directly into free cash flow. Then that machine takes most of that cash and hands it back to shareholders. That's basically P&G. Yes, revenue was about $85 billion. Profits were around $15.2 billion, and they returned about $16 billion to investors through dividends and buybacks. But the real story is how unbelievably efficient they are. Inflation pushed up costs, but P&G still protected margins through a mix of smart pricing, relentless cost-cutting, and continued investment in brands. P&G splits its business into 5 main categories: beauty, grooming, healthcare, fabric and home care, and baby feminine family care. But the really crazy part is this. Their fabric and home care segment alone, with Tide, Ariel, Mr. Clean, is so massive that if it were an independent company, it would be one of the biggest consumer goods companies on the planet. And across all categories, they continued to grow organically. Which tells you one thing. Even when people are trying to save money, they still don't want to gamble with low-quality toothpaste or laundry soap. Trusted brands win in tough times. P&G is pushing hard toward net zero emissions by 2040. They're cutting water usage, redesigning packaging to be more recyclable, and making their supply chain cleaner. And this isn't just a PR move. Modern consumers, especially younger ones, actually pay attention to sustainability. And P&G knows that being environmentally responsible isn't just the ethical thing to do. It's also a competitive advantage in the long run. If you want the behind-the-scenes view of the company, this is the section. And the story is pretty straightforward. They raised prices, which helped growth. Volumes didn't really move much, but they didn't fall either. That's important. Raw materials were expensive, but supply chain improvements helped offset the pain. They continued to invest heavily in advertising because protecting brand strength is non-negotiable. Basically, P&G isn't winning because of big, risky moves. They're winning because they're disciplined. They focus on margins, efficiency, and consumer loyalty, not hype. Now, even giants have weak points. Foreign currency swings can hurt earnings. Emerging markets can be unpredictable. Private labels are getting better. Commodity prices can move fast and hit margins. But the good news is that P&G is so diversified across products, countries, and price tiers that these risks become more like bumps in the road than actual threats. These pages are the usual accounting details, balance sheets, cash flow statements, all the technical stuff. What matters is that everything looks exactly like you'd expect from a company often called a forever stock. Low debt, great margins, steady cash flow, predictable earnings. No surprises. And that's a good thing. So what does all of this mean for investors? The short version. If you want stability, P&G is still one of the best places to find it. Their pricing power is incredible. Their cash flow is top tier. The company is quietly rock solid in a world that feels anything but stable. But it's not perfect. Volume growth is slow. That's the trade-off with mature companies. Commodities and inflation can squeeze margins. Competition is always waiting. And emerging markets can add some volatility to results. Conclusion: should long-term investors care? If you're looking for fast growth or excitement, P&G is not going to give you that. But if you want a company that compounds in the background while you live your life, this is it. This report makes it clear. P&G wins with discipline, consistency, brand power, and reliable cash returns. It's not a rocket, it's a fortress. And for many portfolios, especially dividend-focused ones, that's exactly the kind of stability you want. What if I told you there's a dividend stock that's been paying investors for over 50 years and just raised its dividend again? Today, we're breaking down one of the most reliable income machines in the entire REIT sector, NNN REIT. Is it still a buy, or is the best already behind us? Let's find out. Incorporated in 1984, NNN is a real estate investment trust that owns over 3,000 freestanding retail properties across the United States. The company focuses on net leases, where tenants are responsible for property expenses like taxes, insurance, and maintenance, providing stable rental income for NNN. Its properties are leased to a diverse group of tenants in industries such as convenience stores, restaurants, and automotive services, with long-term leases that reduce turnover risk. The company is currently available with a 5.97% starting dividend yield, while the 5-year average was 5.13%. The price to FFO ratio is now 11.5, compared to the 5-year average of 13.4, and the sector average is around 14.8 at the moment. The company is already available for $40, while the expected price is estimated to be between $42 and $51. Based on these metrics, the company appears to be slightly undervalued. The company currently pays out $2.40 in dividends per year, distributed quarterly. The next dividend payment will be on February 17th, and anyone who holds shares by January 30th at the latest will be eligible to receive it. The most recent dividend increase was 3.4%. Over the past 5 years, they have raised the dividend by an average of 2.4%, and over the past 10 years by an average of 3.3%. This isn't the highest growth rate, but given the already high starting dividend yield, it is acceptable. Over the past 12 months, the FFO payout ratio was 69%, and the expectation for the next 12 months is the same. This is well below the commonly accepted 90% threshold, and it has consistently stayed below that level for the past 15 years. The adjusted FFO per share is not growing very quickly, but it is steadily increasing year after year. The same is true for free cash flow per share. This is clearly reflected in the FFO per share growth chart, with the only notable exception being during COVID, which is not surprising. The same pattern appears on the sales growth chart as well. As is typical for REITs, the company issues new shares every year to fund developments and dividend payments. As long as total sales continue to grow at least at the same pace, this will not pose a long-term problem, and in this case, that condition is being met. Debt management is something the company's leadership will need to pay more attention to going forward because the company's debt has visibly increased due to COVID and the high interest rate environment. However, there is no major concern at this point, since the interest coverage ratio, despite trending downward, remains safely above the expected level of 2. To briefly summarize the points above, the company is available with a nearly 6% starting dividend yield, which was most recently increased by 3.4%. It holds a BBB plus credit rating, which is considered strong, and the dividend appears to be safe. Based on the fundamentals, the company may be slightly undervalued. It is most suitable for more conservative investors who are comfortable with slower but steady growth, with the added bonus of a high initial dividend yield. And now, we're diving into NNN REIT's latest investor presentation from November 2025. This company is one of the most stable net lease REITs in the US, and believe it or not, they've raised their dividend for 36 straight years. That's consistency you can really count on. So let's talk about what makes NNN tick and whether it still deserves a spot in your income portfolio. NNN just wrapped another steady quarter. Their core FFO per share grew 1.2% year over year to 85 cents, and AFFO per share was up 2.4% to 86 cents. Not huge leaps, but steady, reliable growth, exactly what keeps dividends safe in the long run. Annual base rent jumped 7.2% year over year, thanks to new acquisitions and strong occupancy. They closed $283 million in new investments this quarter at a 7.3% cap rate, solid compared to the sector average. Year to date, they've invested $748 million, beating their guidance. At the same time, they sold 23 properties for $41.3 million. The interesting part, some of these sold at a 5.9% cap rate, while new purchases are higher. That spread boosts long-term returns. They also raised $71.7 million in equity and issued $500 million in senior notes at 4.6%, giving them extra financial flexibility. And the dividend? 60 cents per share this quarter, up 3.4%, with a 70% AFFO payout ratio. Very sustainable. The strategy here is simple, and that's actually what makes it strong. NNN focuses on single-tenant net lease properties, meaning the tenants cover taxes, insurance, and maintenance. That keeps operating risks super low. Leases run 10 to 20 years, with the current portfolio averaging 10.1 years remaining. Only 3.2% of leases expire through 2026, giving them remarkable cash flow visibility. And the numbers speak for themselves. Occupancy has never dipped below 96.4% in the past 20 years. And they pick prime Main Street locations, keeping rents strong and sustainable. Their portfolio is massive, 3,697 properties, 39.2 million square feet across all 50 states, with over 400 tenants in more than 35 industries. Top tenants run an average of 1,731 stores each, giving NNN incredible resilience and low earnings volatility, even in recessions. NNN's acquisition approach is disciplined. They don't just look at current tenants, they buy based on the quality of the location and potential future tenants. Lower rents make it easier for tenants to succeed, which drives higher renewal rates and long-term occupancy stability. Since 2010, NNN has acquired over $10.4 billion in properties. 72% through relationship deals at an average 7.4% cap rate, and 28% through market or auction deals at 7.1%. That gap between purchase yield and cost of capital is what fuels long-term FFO growth. The portfolio is well diversified across regions. No single area dominates. Southeast, 25.4%, Midwest, 24.4%, South, 24.4%, Northeast, 13.8%, Rocky Mountain, 7.6%, West, 4.4%. The top states by property count are Texas, Florida, and Ohio. This kind of geographic spread reduces economic and regional risks. Financially, NNN is rock solid. Their capital structure is 62% equity and 38% debt, very conservative for a REIT. The $4.95 billion of debt carries a 4.2% average interest rate, with 10.7 years average maturity. No floating rate or secured debt. Interest coverage sits at 4.1 times, and the maturities are nicely laddered out to 2052. In a high-rate environment, that's a huge advantage. Let's talk dividends. 36 consecutive years of increases. Their current annual dividend is $2.40 per share, yielding 5.6% as of September 2025, with a 70% AFFO payout ratio. For anyone chasing reliable income, this REIT is built for you. Over the long haul, NNN consistently beats the REIT industry. 25-year annualized return of 12.3%, 20-year 9.6%, 15-year 8.7%. Sure, the S&P 500 has outperformed in the past decade, but for steady income compounding, NNN remains a top-tier performer. Strengths: what NNN does exceptionally well. Extremely stable income with long-term net leases, high occupancy over decades, minimal lease expirations. Safe, growing dividend for 36 years. Conservative balance sheet with long-term fixed debt. Disciplined acquisitions at attractive cap rates. Massive diversification across states and industries. Potential risks: slow FFO growth, mid-single digits. Retail-focused tenant base, somewhat sensitive to downturns. Large absolute debt despite good management. Stock price volatility. 1-year return of minus 7.1% despite strong fundamentals. So the conclusion is, NNN REIT is the ultimate sleep-well-at-night dividend investment. It doesn't aim for explosive growth, but it delivers decades of consistency, stable cash flow, industry-leading occupancy, and one of the longest dividend growth streaks in the REIT world. If your goal is long-term income, stability, and low volatility, NNN is a strong candidate. If you want fast growth or tech-style returns, it may feel slow. But for dividend investors, this REIT is one of the most reliable income machines you'll find today.
Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.